Alrighty, folks, if you listen to my daily financial news on April 29th, you know that I think stagflation has gone from unlikely to, quite frankly, probable, which is not a good look. One of the answers to beating back stagflation might be taking rates higher. And I want to do a what if. What if the cost of capital to buy a home goes to 10%? Folks, we are talking double digits. We are talking Paul Volcker-esque. So I want to have this conversation with somebody who's been in the game almost as long as I have, Mr. Bill Allen. Bill, welcome back. How you doing?
I'm doing good.
Yeah. Can you imagine a world where mortgage rates are suddenly 10%? Jerome Powell essentially says we're not having stagflation. We are going to force the economy into a recession by just jacking up rates, and suddenly mortgage rates are 10%. Let's talk about single family and residential first, and then we will go into multifamily because I think the outcomes and impacts will be different. But Bill, you've bought and sold a lot of single family homes. You still are. So what do you think happens if mortgage rates are suddenly 10%?
Okay, well, let me ask a clarifying question. So, are they at 10% like right away today, or is it a few years from now where people have kind of normalized to 5 and 6%? I think that.
So so yeah, let me set it up. So let's just say Jerome Powell, they have a Fed meeting on that comes out May 1st. Let's just pretend on Wednesday he shocks the market. He takes the Fed funds rate up 150 basis points. The 10-year note jumps immediately. And by the time we wake up Friday, mortgage rates are 10%. So we're talking immediate, we're talking sudden. I am not calling for this. I am not calling for this. I just want to do a what if scenario.
Got
So
it.
that there you go.
Got it. The reason I ask is because I think there's like, if I call it, I would call my dad, first of all, like, and because he lived through, 15, 16, 18% interest and was actually like buying houses around that time. And everybody was, but it was kind of normalized then. So the challenge here is that just a couple of years ago, like 2 years ago, the mortgage rates are in a 2 and now it's at a 10. That's very different than a year or two from now where you're like 5 and 6% is normal, and then they go to 10, because that's the exact same feeling that we just got when it went from like 2 to 7.
Exactly.
So we actually just like lived through this. So that like we saw almost exactly what I feel like would happen here, is that the fact that people would be priced out of houses, obviously. So you're kind of knocking down a few. People are deciding to, because we just had twos. So people have mortgages in the twos. Like I'm looking at taking over a house sub 2 right now, a townhouse in my area, 2 bedroom, 2.5 bath townhouse. They have a $220,000 mortgage at 2.9% interest. And I can drop 90K to them and own this house for the next, 15, they got 5 years paid down too on the mortgage. So that would be a great deal for me. And so, but nobody's going to want to sell their house. So what I think would happen is mortgage rates go up to 10%. The people who, I mean, I've been paying 12 to 15% money on my houses for the past forever. So that's not a crazy number for me, but a typical home buyer is, and nobody's selling. The people are going to continue to rent. So if you own real estate, your real estate value is going to be great. The demand for rental houses are going to go up. I feel like the hedge funds and all the people that most of us hate are going to continue to buy up properties all over because they don't care about 10%. That doesn't bother them at all. They're just going to raise stupid money from Wall Street folks and just buy a whole bunch of houses out there. And I legitimately think we will become a renter nation. People will be scared to buy a house for a while. And the hedge funds will buy up the properties, and we'll get as many as we can, but I can't raise $1 billion or $10 billion in the next, month to buy as
Right.
many houses as I wanted to. And I think the inventory will go down. So we won't really see like a massive drop in the housing prices just because we have low inventory right now. Builders will stop or slow building a bit still too, because they're uncertain about what the future is. And I think it's like kind of what we saw maybe like 5 months ago, but taken up a notch.
Yeah.
So I don't know if you want me to go deeper on all
No,
the
I think
details, but that's kind of what I see.
I love how you just pulled that together so quickly because we don't prep these things. You didn't have a heads up for what we were going to talk
Yeah.
about. And I agree. I think your point about we've already seen what's going to happen. Like we saw this 2 years ago when rates go from 2 to 6. Then we saw what happens when you go from 5 to 8. Folks, transactions will plummet. Inventory will drop. And then the other thing that I love that you talked about, and you're absolutely right, is creative financing will explode. This was what your dad went through. In the early 80s, when rates were 18%, you know where deals were getting done? They were doing, it wasn't called subject to back then. It was called a loan assumption.
Yep.
But there were still deals getting done where people had to get out. I think existing home sales, the other thing that I think is interesting that I want to play with, Bill, is it will be very easy to find the motivated sellers. Because the other thing that you and I've done a lot is we buy from motivated sellers. Sometimes they have to sell. Like, think about this, folks. Back in 2010, my market fell 75% peak to trough. There were people that had to sell during that time because of life events. They were competing with foreclosures and short sales, but they had to sell. So they had to take what the market would bear. They couldn't hold on. They couldn't do whatever. So it is also, I think, going to be easier to find motivated sellers. And then one more point before I throw it back to you. I think 10% mortgage rates scare the bejesus out of buyers. I think our competition disappears because they're not financially disciplined. They don't understand less competition is a good thing. If cost of capital is 10% for everybody, that's awesome because I know I will do the work. I will write more offers. I will do more follow-up, and I'm more creative. So again, I think the winners win and the losers lose in a 10% market. What do you think of all that?
Yeah, I agree with that. I mean, the affordability, it would just continue to crush the middle class, really.
Yeah.
That's it. Like the rich people will still be really, really rich. And I mean, a lot of the lower class folks, they're still just renting anyway, not even thinking about buying a house. And that middle class just gets like decimated and just the gap becomes massive. Yeah, that's what I would see. I also think that real estate agents will continue to get washed out of the market. We've already seen that happen. It's not really reported on the loss of jobs, right? So the W-2 employees they're all 1099 contractors, so it doesn't look like unemployment skyrocketed, but a whole industry has been destroyed of loan officers and real estate agents. So that'll continue. It'll also like kind of leave like the best of the best. You talked about that a little bit of like the folks that can be creative, that can kind of pivot. But it would be such a fast shift and change that you're 6-7% has not been normalized at all.
Right.
It really is still 2 to 10 now, which
correct.
I mean, affordability drops so much. 1% interest affordability drops a ton, like 11% affordability. So now you're looking at, take it up another 4%. I mean, you just drop like 40% on your affordability. So now if you were looking at an $800,000 house, you're looking at like a $500,000 house, which might not even exist in your area.
Yeah, it would destroy it would be the worst affordability ever, right? Even today, how bad it is. It's not 1981 bad. We throw it up to 10%. It sets the record for the least affordable market. You're absolutely right. Well, now let's change gears to multifamily, commercial. I think this could get ugly because again, for a lot of folks that don't know, there's a refinancing risk inside of commercial. Lots of 3s, 5s, 7s, and 10-year paper. That if you come out and you have to refi, like even if you made your payment on time and you take rates to 10%, that's a problem. The other thing that happens is cap rates explode. Can you imagine what would happen to cap rates? Right? We saw cap rates at 3.5%, 4% during the craziness of the pandemic. They're today at 5%, 5.5%. You throw interest rates up to 10%, that's a problem. Then you talk about raising private money, right? Today you could raise private money at 11 or 12. Dude, if you're getting 10% on a 10-year treasury or a money market account, you just sit back and save. That's what happened in the 80s. People just saved because you were making 18%. So I think 10% mortgage rates hurts residential. I think it could be catastrophic for commercial. What do you think of all that?
Yeah, on the commercial side, so I raise a lot of capital for commercial deals. And so one thing that a lot of people might not realize that happened when the rates even went up recently in the past year or so is the first thing that we were seeing is, like you said, a lot of people are doing bridge debt at when it was 2%, not expecting like 6 or 7%. They were expecting maybe 3 or 4. They had underwriting for an increase, but not that big of an increase. So then they can't afford, they're doing cash in refinances. And with that, yeah, everybody's like, I love the cash out refinance, tax-free money that we'll keep doing this forever. And now they're having to do cash in refinance. And so there's 2 options there on a commercial deal when you have to do that. And these are forced refinances. They like, it's not like, oh, I refinance because I want to. It's like, no, I have bridge debt. This loan is due. And bridge debt is just like short term, like almost like a hard money loan if you know
It
single
is.
family. And so this thing is like, now it's an extra 20, 30, 40, 50, $100,000 fee per month if you have to extend it. Not like a
Mhm.
little bit. It's like and sometimes you can't even, they'll just foreclose. And
Yeah.
so the problem is then you're forced to refinance at whatever rate it is. And now you got to do a cash in. So that means you got two options. You call your current investors and do what's called a capital call. And so you go out to your current investors, do a capital call, and say, "Hey, I know that you put in 250,000, but we need another 100,000 to refinance now. And I know I was going to pay you, but now what I need you to do is pay us, like put more money in the deal. Oh, by the way, for the same percent ownership that you already have." And then if they say no or can't do it, because most of these people give you like, this is all the money I had, I don't have any extra money. Then the next option is you go out and you raise more money for the deal. And what you then do is you water down the equity that your other people had. And so this has been happening. I wouldn't say like I know a lot of people that are doing this, but there are a lot of people doing this. They're just not in my circles. Or they're just having to take it to foreclosure. And we're seeing
Mhm.
that. And so take it to 10, that gets a lot worse for anybody that's still in a bridge
Yes.
loan. And when you said 3, 5, I just want to explain that real quick. A lot of these commercial loans, they might be like an amortization of 20 years, but
Mhm.
they're a 5-year balloon a lot of times. So there's a 520 you might hear, or like a 315 or 320 or whatever it is, maybe a 530. And the amortization is there, and maybe it's interest only for a year or two, but then at 5 years, the bank gets to choose whether they want to do a balloon payment. And then
Yep.
you have to go out and shop a refi, either with the same bank or with somebody else, usually somebody else. So that's the challenge you run into. And a lot of these people probably bought really heavy around
Hmm.
COVID time. So that would put us at the 5 years around next year to 2025, 2026. So
Yep.
if that would hurt. The other thing that not a lot of people are talking about that I hear at least is that LTV on these apartments were 75% when it was 2%. And now it's about 65%. So I'm having to raise 10% of the purchase price more now than I was before. And the capital market has tightened so much. Like you said, if they're getting 5.5%, 6% in a money market account right now, which would go to like 8, maybe eight and a
Yeah.
half at a 10% interest rate. I don't know that I'm overly like excited to put something into an area that seems to be volatile and other investors that are friends of mine are complaining about, let's say, like,
Yes.
oh, somebody
Exactly.
just called me for a capital call. Watch out. This is happening everywhere. And it might not be you. So this is the hardest market that I've ever raised money into. So I agree with that. I think also there's probably some people who got a little bit like ahead of their skis that would get eaten up. But I also think to that point, there's still going to be some deals out there. So if you know how to raise money and you know what you're doing, just like single family we talked about, you'll be able to take advantage of some of these people's misfortune. I've seen some buildings trade at like 20, 30, 40 cents on the dollar recently.
Mhm.
There was like I read an article about like a skyscraper that was sold for like 10% of what it
Mhm.
was purchased for just a few years ago. I'm not in the skyscraper market, obviously, but things like that are just
Yeah.
coming up for sale if you're connected, you know the right people. The banks don't want the inventory, so if you can
Mhm.
figure that out, just like people figured out short sales like crazy in 2008, it'd be a good game for those that know how to pivot. So there's a couple of thoughts on that. I do think that really the capital market is the most challenging side, and what's of raising capital. The big thing that you're going to see is just like I talked about in single family, these big hedge funds, these big players that have tons of money, really deep pockets, they'll eat up the stuff and buy it for pennies on the dollar, and the rich will just get richer.
I think, if you take rates to 10% by this Friday, again, just an example, not just a what if, I'm not calling for it. I think it hurts single family homes, really slows the market down, but it could potentially crush commercial because of the debt structure and the terms and just how it happens. And again, I also think you're absolutely right. I've said it a lot and mean it. Where there is great pain, there is great opportunity. And most of my wealth has been built by putting deals together when others aren't looking. The amount of noise and pain in the commercial markets that would happen if rates suddenly went to 10 would be astronomical. But if you look around and you're doing good work, you would do I feel confident saying this. I would do my largest and best multifamily deals probably within a year of rates going to 10%. Because it would take a little bit of time for people to figure it out. It would take a little bit of time for people to give up. It would take a little bit of time for banks to foreclose. And then I'd be standing there with a bag full of money saying, I'll take that one. And I don't want that one, but I'll take that one too. It'd be pretty awesome.
Yeah, and this is exactly what I'm talking about. The number one thing you'll need to do is prep your people, the people that are closest to you. I have a plan. This is my business plan for this. This is how we're not going to do capital calls. This is what you're going to hear from other people. You're going to hear this. And because this is legitimately how the gap just separates like crazy, is people that have money that can stroke those checks, they can buy stuff on massive sale and take care of other people, like take advantage of other people's misfortune. And if you're in the right place, you know the right people, you have cash, those kind of things. And I think that's why a lot of people are sitting on cash. I just always want my cash at play. Like I just put my last $200,000 in one of our deals that closed this past week in Murfreesboro, Tennessee. We bought 290 units. When people are saying, "Oh, cash is tight," I don't have any money. I just put it all in. And because next year I'm just going to make more, and then I'm going to put it in and put it in and put it. I just always wanted to play. We got a lot of people that are like squirrels right now, just hoarding their nuts, just keeping them in the bank, and that's the challenge that we have. The banks, the other problem that I kind of mentioned is the bank is not only will they go to 65, they might just stop lending completely in that asset class. They'll just lose appetites. They'll stop and not even. You just might not even be able to get a loan from the banks that you're working with right now. That happened in the short-term rental game for a while. A lot of the commercial banks that were lending very heavily on short-term rentals 5 years ago, 3 years ago, 4 years ago, they just stopped. They just started pulling those loans. We don't have an appetite for that anymore. Mm-hmm. And that'll happen for a while. During COVID, all the hard money lenders stopped lending for 3 months. Yeah. Same thing with banks. I don't know what's going to happen, so we're just going to shut it down.
Even single families, they got turned off. I mean, people don't remember this. In 2010, I went to get a loan on a bank for a property I was getting 50% off. They told me, hell no. I was the problem, right? You can only do 4. Remember when you could only get 4 conventional loans?
Yeah. Yeah.
It could happen, right? And you're absolutely right. The banks, and I guess the other point is we would have a banking crisis. There would be commercial banks around the countries whose balance sheets get shredded. Yeah. We would be left with 5 or 6 big banks. They would probably have to be bailed out by the government. 10% mortgage rates overnight, like I'm doing in this hypothetical, would be a disaster and would cause a recession. We would be in a recession immediately. But again, not calling for it. I just want to do a what if because I think it's fun to think about. Any other thoughts about this crazy idea?
No, I just keep going back to it just makes the gap so much bigger when this happens. The recession crushes the people in the middle class. And, maybe some of the really rich people have to, I don't know, sell one of their jets or something. But that's
exactly.
They really just have so much money that there's a line where it really hurts people. And it sucks that has to happen. But I mean, that's pretty much what it is. Let's create a recession. Let's get people to lose their jobs to a certain point where, okay, now we can spark things up again. It's really horrible. I hate it. But that also, I think, for everybody that's watching this, should be the drive for you to learn a skill, learn real estate, learn a way that you can have excess capital, excess money, invest it, have these assets, and take care of yourself so that you're not reliant on somebody else to whether what happens with the tax rates, what happens with this, what happens with inflation, what happens. And that's why I love real estate. That's why I love real estate and I love business, because my business mind allows me to make the money and I get to choose what I make and how I make it. And then my real estate gets to protect me against inflation. When that happens, that's good for all my buildings. It's really good for me when that happens because more people will be renting. The rent's going to go up. All that stuff's going to happen. And it's just my property values will go up throughout this. Yeah. And that's one thing we didn't talk about is the value of the property that does withstand, that does stay. It goes up and up and up over time. You see that happen. You might take a dip and then it's going to go way up following that. So
yeah, inflation is a feature, not a bug. Not a lot of people understand that. Mr. Bill Allen, you are on my Mount Rushmore of real estate investors. Where can people find you?
I have a YouTube channel that's my name, Bill Allen, and then that's probably the best place. I mean, it's at Bill Allen REI everywhere: Instagram, YouTube, Facebook, that kind of stuff.
There you go. Thank you, buddy.
Thanks.